Welcome to the Capital Markets Review for the fourth quarter of 2018. My name is Patrick Yankee with Yankee Financial in Raleigh, North Carolina. Securities offered through Raymond James Financial Services. As always, my purpose here is to inform and to answer questions on the economy and the financial markets. This isn't meant to be a prediction for the course of the market for the rest of this year or beyond. Rather, it's a review of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management for the simple way they present complex ideas. Most slides have multiple charts on them. I'll point out the information I think is most relevant. The opinions expressed are mine and not necessarily those of Raymond James, and J.P. Morgan is not affiliated with Raymond James. So this quarter, I'm going to start with an economic update, then we'll talk about interest rates, talk about the equity markets, and then what investors should be doing. It's been a bit of a bumpy ride to get over 10% higher on the S&P 500 by the end of last quarter. What's really interesting on this chart is the comparison with last quarter. The S&P 500 rose from a gain of about 2.5% to about 10.5%. It was one of the best quarters since 2012. Most of the rest of the world is largely unchanged, but unfortunately for U.S. investors, a strengthening dollar took most of the gains made in foreign investments so far this year. Like it or not, the U.S. leads the world economically. When we fall into recession, the world tends to follow. Therefore, it's important to keep up with the U.S. economy even when considering foreign investments. Year-over-year GDP growth was over 4% in the second quarter. You can see on the left-hand chart that there is an unmistakable rising trend in GDP growth in recent quarters. On the right, we're looking at the components of GDP. Consumption always makes up the largest chunk in a market-driven economy. Therefore, it's important as investors to know how consumers are doing financially. GDP growth is returning to historical averages. When the price of oil fell at the end of 2014, many rigs in the United States were shuttered as uneconomic at the lower price levels. These shuttered rigs are available when oil prices rise to economically feasible levels. Consumption has grown at an average of 1.4% a year historically, and oil supplies have grown at a more erratic rate. Recently, inventories had fallen, with a dramatic increase of demand in China primarily, and renewed sanctions on Iran. Note the chart in the bottom left. The drop in the price of oil, with increased inventories, brought about the idling of about 2/3 of oil rigs in the U.S. The higher price of oil has made it more economical to reopen some of those rigs already. In the short term, higher oil prices will likely lead to an increase of supply as active rigs increase to meet demand. In the longer term, the price will likely rise as demand continues to grow at its historical rate while supplies seek equilibrium. Demand will be driven by economic growth, while supply can be somewhat controlled by oil producers. Expectations call for oil production to be less than consumption in 2018, but about equal in 2019. The job market is like any other market. It moves by the forces of supply and demand. When there is an oversupply of available workers, wages tend to be reduced as employers don't have to offer much over the prevailing wages of their competitors. When employment tightens and there are fewer workers available, wages tend to rise as employers compete for available manpower. Since the last recession, unemployment came down considerably, but wages haven't been rising. That shows the softness in the jobs market, despite falling unemployment. Recent economic activity has reversed this trend and wages are finally rising. One way we can measure the true level of unemployment is to consider the labor force participation rate. This shows the percentage of the working age population participating in the labor markets. At under 63%, we are still at levels not seen since the mid-1970s, as reported by multiple media outlets. As the economy strengthens, the recent trend has arrested its descent, and there is a rising trend. Some of the drop in the participation rate is attributable to people leaving the labor force due to aging. Some economists are predicting that the low unemployment rate will keep GDP growth rates muted. This thinking has some calling for immigration reform as a means to provide a supply of new employment. This is an area where I disagree with those economists. Although the official unemployment rate is low, the economy is not without prospects for new employment. The labor force participation rate is a source of sustainability for a continuing expansion. The rate is showing signs of growth. The real jobs boom is evidenced by a rising labor force participation rate. Consumers' balance sheets are very strong in the aggregate. Total assets have reached new highs, while liabilities are very low. In fact, the amount that debts are costing households as a percent of disposable personal income remains at extreme historic lows. Another thing to consider for the consumer is the fact that after 7 years, bad debts fall off credit reports. Access to credit adds fuel to consumer fires. We are beyond the 7-year point from the last recession. Consumers have greater access to credit and more spending power than they have had in a decade. Debt levels increased slightly from last quarter, while asset levels are significantly higher. Another thing to note about this is that rising interest rates won't have a strong direct impact on consumers' balance sheets. 2/3 of their liabilities are fixed in mortgages, which won't be directly affected by rising interest rates. The federal government's finances have improved from the last number of years. At the peak, the federal government was borrowing more than 35 cents of every dollar they spent. However, in the last couple of years, the borrowing rate has grown from a low of about 12 cents of every dollar spent to 19 cents of every dollar now. The long-term forecast calls for borrowing levels to increase going forward, and at an increasing rate over recent quarters. It's interesting to note that Congressional Budget Office expectations for GDP growth have been increasing every quarter as the economy improves. They now reflect the current year's numbers, but they fall back to the previous trend of less than 2% GDP growth going forward. If higher rates of growth are realized, this can help federal finances through greater tax revenues. Only time will tell. Manufacturing indices are extremely healthy. It's not often we see all areas of the world growing robustly at the same time. This shows the breadth and strength of the global economy, and it is stronger this quarter than last quarter. Inflation remains very tame, well below the historical averages. However, there are areas of the economy with greater than average inflation rates. Unfortunately, some of the higher inflation items like food, housing, energy, and medical care affect everyone, while some of the lower inflation items like recreation and transportation don't affect all economic participants. The future will likely see a return to more normal rates. If economic growth rates accelerate, higher inflation is likely to be one of the consequences, especially with an expanded money supply. Inflation assumptions can be a starting point for investment assumptions. Starting with low inflation and having it rise is a scenario we've seen 8 times since 1974. In this environment, equities and commodities have been the best performers, although the commodity returns are greatly skewed by the late 70s in my opinion. Bonds and cash have not fared well in these environments. We are in the 4th longest expansion since World War II. However, we are coming out of the deepest recession in the same time period, with the weakest recovery too. Look at the chart on the right. The size of the bubbles shows the depth of recessions, and the height of the bubble shows the amount of time each lasted. The most recent recession, sparked by the fiscal crisis, was the deepest and the longest lasting recession in over 60 years. Typical recessions are brief slowdowns in the economy. Although there is a lot of hype and speculation that the next recession will be as bad as or worse than the last one, history would suggest otherwise. Investors should invest prudently, but not base their investment decisions on fear of the last recession. This chart shows a comparison of economic expansion since the end of World War II. Until recently, some of the narrative over the last decade was that we were in a new normal for the economy. The growth rates weren't as robust as the historical averages. This is one reason for encouragement with a new trend of rising growth rates. History suggests there is room for growth, even if trends just return to the historical averages. So let's talk about interest rates. After falling for the last 31 years, bond yields are recovering from their historic lows and have risen sharply this year. Average nominal yields for the long term have been around 4%. This means that the nominal yield on the 10-year Treasury would have to rise at least another percent or so to get back to the historical averages. The long-term outlook for interest rates is a rise toward the long-term averages. The movement of interest rates will impact bond investors as they watch their values fall. Falling bond values will also make bond holdings illiquid, as asset bids may not match realized results when sold. This remains a dangerous environment for bond investors, as rising interest rates may counter coupon payments and remove the reward from the risk-reward equation. When interest rates return to their mean value, how much more can be lost in the bond markets? From current levels, a 1% rise in interest rates will see about a 17% loss in 30-year treasuries and more than 8% lost in 10-year treasuries. Those with significant bond holdings, especially in treasuries, should carefully consider their asset allocation. Among all bond categories, only 2-year treasuries, convertibles, floating rates, and high-yield securities would see positive returns in this environment, and mostly due to coupons. And the chart on the left bears this out. With the rise in interest rates so far this year, 30-year treasuries have lost about 6.5%, and 10-year treasuries have lost about 3.75%. 2-year treasuries, convertibles, floating rates, and high-yield securities have positive returns. The Fed expects to continue on a path of raising the Fed funds rate, but there is an end in sight as they are reaching their goals. Some have said this is an aggressive schedule of rate hikes, but note the slope of the increase versus previous increase. This one is certainly more gradual. The average rate of increase over the last 5 rate cycles was about 2.5% per year. This one is averaging about 1% a year. It isn't terribly aggressive. One telltale sign of impending recession is an inverted yield curve, where short-term interest rates are higher than long-term rates. Despite flattening over the last 4 years, the yield curve remains positive, although just barely. An inverted yield curve has been a consistent signal of impending recession. Many are watching for this signal, and since a great deal of short-term movement in the markets is driven by psychology, it may be self-fulfilling. It's worth watching, but it isn't always reliable. Although it has preceded the last 7 recessions, there have been false positives. Also note that people tend to borrow on the long part of the curve and invest on the short. Higher short-term rates can be stimulative, while stable long-term rates may not be harmful for existing debts. It's important to realize what is happening behind the curve. The short end of the curve tends to be driven by actions of the Fed. The Fed tends to raise the Fed funds rate during economic expansions. Long-term rates are driven by supply and demand for bonds. Investors are still piling money into bonds despite the long-term risks. This is holding rates low as short-term rates are rising. This scenario isn't a sure signal of pending recession. Except for a brief sell-off in 2013, which was painful for bond investors, money has been building up in bond holdings. This is holding down long-term interest rates. As the Fed increases short-term rates, this is bringing the possibility of an inverted yield curve. There is another story to consider with interest rates. The Fed greatly increased its balance sheet with treasuries after the fiscal crisis. They are the buyer of last resort for the federal government, as the government issued more debt with increased deficit spending. To prevent failed treasury auctions, they bought to keep the debt markets liquid. They continue this policy, although they are trying to taper it off, mostly by allowing holdings to mature. What this means is that the Fed has influence on both ends of the yield curve in this environment. They have direct influence when raising the Fed funds rate, and their purchases to keep the debt markets liquid have helped rates stay low on the long end. What will this mean in the long term? Nobody knows yet, but it is interesting to consider. The Fed having such influence on both ends of the yield curve is fairly unprecedented. Let's talk about the equity markets. Between March 9th of 2009 and the end of September 2018, the S&P 500 increased by 331%, excluding dividends, and that's a huge increase. There's hardly a period of time that is shorter than the period of time between when the client thinks it's too early to get in and the market analysts think it's too late. Those with a short-term view of history would be forgiven for seeing a market peak at these levels. Consider, though, that what we've been through is known as a secular bear market. There are really 2 phases when evaluating PE ratios. The secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 16.8, and that's up from 16.1 last quarter. The yield on the S&P 500 is less competitive with 10-year treasuries. And just a mid-October update, with the volatility that we saw in mid-October, the forward-looking PE ratios actually came down to below the long-term averages at about 15.7 times earnings. And the main reason that we invest in equities is the earnings of the companies on the exchanges. Although earnings dropped some quarters ago, earnings have picked up and have resumed their track to record levels. Economists are calling for earnings to continue their rapid growth. Normally, when the economy is headed toward recession, wages spike as a share of company profit margins. Given that wages haven't risen much in this economic cycle, while earnings have, we are about as far from this situation as we've ever been. In the early quarters of this year, investors were concerned about high valuations in equities. The price-to-earnings ratio, or the PE ratio, was approaching 1 standard deviation above the 25-year average. After bouncing around and remaining level most of the year, the S&P 500 increased in just the last quarter, and the PE ratio is still close to the average. There are 2 parts to the PE ratio. Holding all other things static, earnings growth will lower the PE ratio, and we are expecting earnings to continue to grow. The question will always be how quickly stock prices move in relation to earnings. And as an update, as I said, the volatility in the middle of this month brought the PE ratio down to the long-term average of about 15.7. When you invert the PE ratio, you get the earnings yield. Since this is how fixed income investments are valued, that can be a tool for comparison of valuations between equities and bonds. Prior to the dot-com bust, bonds had a greater earnings yield than equities. That's part of their appeal for investors. Since the fiscal crisis, equities have had the edge. That still remains in the current environment. This means that investors looking for yield will find better value in equities than bonds. This chart shows secular bulls and bears. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. So is it over yet? Only time is going to answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. As mentioned earlier, strength in the U.S. economy helps to bolster overseas economies. Overseas valuations are more attractive than domestic markets. Would you want to go back in time relative to the S&P 500 and invest at lower valuations? That's kind of what's represented overseas. No investment is without risk, and this isn't a sure thing by any means, but the valuations are more attractive here than in domestic markets. Make sure your portfolio isn't too America-focused. Overseas diversification at this time can improve your long-term returns. Historically, there's been a bit of a seesaw between relative performance of domestic equities and overseas assets. One leads for a time and then the other. The most recent period has seen domestic markets lead for the longest period in almost 50 years. This and the prior chart suggest domestic investors may find higher relative performance overseas in the coming cycle. So what should investors do? And honestly, this section doesn't change all that much from quarter to quarter. You wouldn't expect it to, because what investors should do is some timeless principles. But what you'll find is that the slides are updated with new information. For example, there's a great deal of cash relative to GDP sitting idle in the economy. The chart on the right shows that over $16 trillion remains on the sidelines in various cash equivalent accounts, and that's still higher than last quarter. That is more than both consumer spending and mortgage debts. These cash assets are non-productive assets for growth and a fuel for further investment returns when they are put to work. The chart on the left shows that cash investors, also those in CDs, are getting next to nothing for their patience. Sooner or later, investors have to take some risk in this market in order to make money. Investors in CDs are accepting that they are not coming close to keeping pace with inflation. The main market alternative to stock dividends is to take an interest rate risk in the bond markets. As shown earlier, bonds aren't a good long-term proposition either, in my opinion, if we realize rising interest rates. It takes courage to invest. Even though the market finished positively 75% of the years in the last 38, the average year saw an intra-year decline of about 13.5%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor, as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor for long-term growth. The dip we've seen so far this year has been 10%, which is below the long-term average, and while the last quarter provided some gains. We would all love to be able to invest without risk. If I offered someone an investment which would have an average return greater than 7% a year guaranteed, most people would jump at it. That's the red line. What that line represents, though, is the average annual return of the S&P 500 for the 20 years ended at the bottom of the fiscal crisis, or the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the short periods of time. Over the long term, they create more financial opportunity loss in a portfolio than that short-term volatility of the markets. In this mathematical example, it would take a loss of greater than 50% in the S&P 500 to return to the 7% average line. It's important to note here, though, that the S&P 500 is an unmanaged index. Some successful money managers have even seen better results. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can make growth a smoother ride for investors. There's another story here. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification and active management is still important. The low volatility of recent markets was an ideal environment for unmanaged indices. If we return to normal volatility, we may return to the normal situation where managed money beats unmanaged money 2/3 of the time. While diversification and asset allocation help mitigate risk in a portfolio, they do not guarantee against loss. This chart shows the benefit of diversification. From 1998 to 2008, having a balance in assets buffered losses and protected gains. Since 2009, having an unbalanced portfolio in the S&P 500 index would have allowed for greater growth rates, but it took until last year to finally catch up to the long-term performance of the balanced portfolio. As volatility returns to the markets, active management and a balance of asset classes may prove valuable going forward. So where is a good place for investment dollars in the sectors of the economy? Look at the sectors the same way we looked at asset classes and you find a similar story. Those sectors you find on the top will one day be on the bottom and vice versa. This chart suggests that a contrarian investor selecting sectors from the bottom of the prior year may be rewarded in the following years. Another method of sector selection is going with the prevailing assumption that future interest rates will be higher than today. In that environment, it would be good to have sectors that are positively correlated to Treasury yields. In other words, sectors expected to rise as interest rates rise. On this chart, that would be sectors other than real estate, telecom, consumer staples, and utilities. Financials especially are expected to do very well in this environment. That doesn't mean defensive investors should only seek securities in these sectors. They should simply make sure investment portfolios don't neglect holdings in these sectors if they agree with the investment premise. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 2.5% or so, the average investor has barely kept pace with inflation over the last 20 years. If they had simply held any one of these other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. I'm always happy to review and answer questions. The required disclosures can be difficult to read in a video. If you go to my website under the Capital Markets Review, you'll find the slides from the previous quarter's Capital Markets Review where you can zoom in and read it more easily than you can in a video. As I said at the beginning, my purpose is to inform and answer questions. The informing part can come through a video, but the answering questions can only be really done one-on-one. My phone number and my email are both here. Please make use of them if you have questions. Financial planning doesn't occur in a seminar setting. It doesn't occur through videos. It doesn't occur through books. It occurs one-on-one in a conversation about where people are now, where they're trying to go, and how they're going to get there. And that's what I try to help people do. So please, feel free to reach out to me with your questions, and I appreciate your attention. Talk to you again next quarter.